Hello friends, welcome back to the channel. Today we're diving into one of the most legendary books in the world of investing, Common Stocks and Uncommon Profits by Philip A. Fisher. Now, Fisher's approach to investing is not your typically buy low, sell high game. Instead, he focuses on finding companies that have the potential for long-term growth, companies that can truly thrive in the years to come. If you have ever wondered what separates successful investors from the rest, this book holds some key secrets. Let's break down Fisher's principles and I'll show you how they can transform the way you look at stocks. Fisher believes that a company's management team is the single most important factor in determining its long-term success. It doesn't matter how great the product is or how strong the market is. If the leadership is not up to par, the company won't thrive in the long run. Think about it. Would you want to put your money into a company led by a group of people who can't make solid decisions? Of course not. Fisher advises investors to dig deep into the company's leadership. Look at their track record, their vision, and their ability to execute. A great example of this is Warren Buffett's investment in Berkshire Hathaway. Buffett always says that he invests in great business with great management, and Fisher was one of the biggest influences in shaping that philosophy. Next, Fisher talks about finding companies with a competitive edge. This is all about companies that that have something unique, something hard to replicate. Whether it is a proprietary technology, a unique brand, or a monopoly in a niche market, this competitive advantage is what allows a company to earn profits consistently over time. Fisher gives the example of companies that have pricing power. If a company can raise prices without losing customers, they're likely to have a long-term edge. Think about Apple. Their loyal customer base and innovative products create a competitive moat that's difficult for competitors to break through. In the world of investing, the bigger the moat, the better the investment. Now, one of his most important lessons is that successful investing is about the long term. He believes in finding companies that are positioned for growth over decades, not just short-term gains. This requires patience, but the rewards are incredible. Fisher gave the example of a company that has managed to grow its market share and profits year after year. Instead of chasing the next hot stock or trend, focus on business with staying power. Think about Amazon. While many investors were skeptical about the company's profits early on, Jeff Bezos was always focused on long-term growth. Fast forward to today, and Amazon is one of the largest and most powerful companies in the world. Fisher also warns against investing in no-growth companies. These are the companies that may be profitable in the short term, but they don't have any prospects for significant growth in the future. Fisher was a huge advocate. Fisher was a huge advocate of finding companies with innovation, companies that are constantly evolving and adapting to change. He also advises avoiding companies that are stuck in their ways with no clear strategy for future growth. If a company is not expanding its business or improving its products, it's likely going to struggle in the long run. One of the most unique techniques Fisher introduces is what he calls the Scuttlebutt method. No, this is not some secret underground approach. It is simply about gathering as much information as possible before you invest in a company. Visa recommends talking to everyone connected to the business: suppliers, competitors, customers, employees. This helps you understand the true health and potential of a company beyond just looking at financial reports. For example, when Fisher was looking into buying stock in a company, he didn't just rely on the numbers. He would visit the company, talk to the people involved with the business, and ask questions no one else thought to ask. This gave him insights that are not available in any financial statements. Finally, Fisher emphasizes the importance of emotional discipline. It's easy to get excited about a stock when it is soaring or panic when the market crashes. But successful investing requires keeping your emotions in check and sticking to your strategy. When you believe in a company's long-term growth prospects, don't be swayed by short-term market fluctuations. Fisher suggests that if you're investing in solid companies with great management, a competitive edge, and strong growth potential, the rest will follow. So, to sum it up, common stocks and uncommon profits is not just about finding stocks that will perform well tomorrow or next year. It is about investing in companies with great leadership, a unique competitive edge, and long-term growth potential. Follow these principles, and you can start building a portfolio that thrives through market ups and downs. And remember, as Fisher says, investing is not about being a rush, but about finding the right companies for the long haul. If you're ready to apply these timeless principles to your investing journey, hit that like button, subscribe, and share this video with someone who is looking to take their investments to the next level. And as always, drop a comments below. What is one company you think fits Fisher's principles? Let's discuss. Until next time, happy investing.